We're going to do a post analysis on all of my option selling transactions on Rowe Price. It's a favorite of value investors. It's got a good balance sheet, nice, steady, and safe dividend. Its main business is providing and managing investments and retirement funds. Option traders are usually interested in generating weekly or monthly income. My option strategy is a little bit different. As a long-term investor, I sell options to lower my cost basis. I sell puts to enter positions at a lower price or make a little premium if the put doesn't get assigned. Then I sell covered calls to slowly lower the cost basis or get called away when I think the stock is above what it's worth. Here's a 1-year chart of TROW, which is about how long I've owned it and been selling options on it. It's at a low of 98 about here and a high of 133 right there, both within about a month of each other back in October, November of 2022. That big swing caused me to roll my covered call out to a leap, which is a long-term option. But we'll talk about that in a bit. I sold my put back here at the start of the chart when TROW was around 120. Then I got assigned about right there, June 17th, at a strike of 110 when TROW had fallen to about 106. So the selling put strategy worked out pretty good. Got a pretty good price on it. I've lowered my cost basis from 110 all the way down to 96.5, assuming I hold my current covered call to expiration, which is in December. So this is an example where selling options has worked out well. It's not always the case, but I believe selling options is worth the time and effort if you enjoy it. If you do it well, you can make a few extra percentage points a year. Here's a line chart showing how the following things have changed over time: the stock price, the cost basis per share, the call strike price, and days to expiration. From top to bottom, the yellow line is the call strike price, plotted every time I sell a new call. The blue line is the price of TROW over time. I plot this every time I sell or close an option or collect a dividend. One goal is to keep the yellow line above the blue line to avoid getting called away. The purple line is the cost basis. It steadily goes down over time as I sell options and collect premium, and each time I collect a dividend. You'd like to keep this line, the purple cost basis line, below the blue and yellow lines, current price and call strike. But that's not always possible if the underlying stock isn't cooperating. It was here though. The distance between the blue and purple lines, this distance right here, is your profit loss at any given time. It's currently almost $8 a share, counting the current option right here. Without selling options, I would have a cost basis of 110 minus the dividends. So I'd have a profit of about $1 a share. But with selling option, it's turned from a 1% gain into a 7% gain in about a year, and more as I wait through December of 2023 when my current option expires. If the yellow line, the strike, goes below your purple line, cost basis, and your blue line, the price, it means you could get called away below your cost basis. That's not ideal unless you no longer like this underlying stock. And finally, the red line down here is the days to expiration, or DTE. It uses the right y-axis, so it's on a different scale over here. See how it spikes up from 40 to 397 when T-Row's price jumped up to 125? I chose to roll my call way up and out here to avoid getting called away. And it's been gradually coming back down over time. So now let's take a look at the individual transactions in a spreadsheet over the year. Let's work our way through this transaction log. On May 24th last year, I sold one put on T-Row with a June 17th expiration at a 110 strike. T-Row is currently going for 120. I got $2 for it, 200 bucks. At that time I had 0 shares. Then on 6/21 I got assigned. Interesting, it says June 17th, but I didn't get assigned until 6/21. So it must have been over the weekend. Maybe it was a holiday. And I bought 100 shares at 110. So my cost basis was 11,000 minus the 200 premium I collected, or 10,800. And the same day I sold a covered call at the 125 strike. T-Row was currently at almost 110. I got $1.55 for it. So my cost basis went down to 10,646, or 106.46 per share. And if I don't count the current value of that option, I made a profit loss of $3.43 a share. So then 7/20 came around, or about a month before that option was going to expire, and I closed it out. This is a roll. So I closed it out for 293, or bought it back, and then I sold a new one at 130, moving it all the way out to October. So I picked up a credit of like $1.20. The difference between 413 and 293. My days to expiration moved all the way out to 3 months, or 94 days. Now, why did I do that? Probably because my call was 125 and the current price was 121. I was a little worried it might get called away. Now I'd probably wait until it gets to a little closer to 125, or even a little above it, but this works. So doing that, I took my cost basis all the way down to 105 with that credit, not counting the current value of that option. Then 2 months later, in September, I bought that call back for 24 cents. It still had a month to go, and I sold a new call November, taking the strike down $5. Now, why would I have done that? Because T-Row had fallen all the way down to 107, so the delta, or the chances of it executing, were pretty low by then, and I'd already realized most of the premium. There was only 24 cents left of that $4.13. So that's why I rolled it down and out to collect about 85 cents premium and 85-cent credit. And that took my cost basis down to 104.43, not counting the value of this option. And I got a dividend, so that's of 120 bucks. I think it pays about 4%, but I forget exactly. And that takes my cost basis down to 103.23. So then, November 7th, 11 days before expiration, I rolled down from a 125 strike to a 115, and I got a $1.20 credit. TROW was at 105, so there wasn't much premium to be realized at that point. And my cost basis went down to 102, not counting that option. But then here's where that big spike happened. Huge spike that happened in October, November. So a week later, TROW had spiked up to 125 from 104. So it had blown past my call, which didn't expire for another month. So I had to make a choice. Did I want to just sit here and let it get called away at 115, probably, or roll it up and away out? I chose the latter. So I paid $16 to close that December call, but then I sold one in December of 2023, 13 months from this date, at a 130 strike, which was above its current price, to try and capture all of that underlying stock price appreciation, and I got paid $19.28 for that, so I got a $3 credit. So by doing that, I lowered my cost basis to 99, but now I'm kind of stuck with this call until December of next year. So I just get to sit and wait. But that's fine. And then I got several months went by. I got a dividend in December of 120 bucks, and I got another one in March of 122. At that point my cost basis was 96. Today, this is Friday, May 5th, the value of that option that was worth $1,900 back here in November, now in May it's only worth $322. So adding that in, I could completely close out my TROW position for $99.66 cost basis, and TROW is trading for 107 now, so that's about an $8 a share profit if I wanted to close my option and then sell my shares, but I don't. I'm going to keep waiting, see what the stock price does, and I'm probably going to keep TROW for a while. Anyway, let's look at my current situation and how I decide what I'm going to do. So here is the spreadsheet I use to help me make a decision on what to do next with each of my positions. So as you can see, here is my TROW record. Here are the headers, for instance, like stock. The stock is TROW, the cost basis is 99.51, the count is Ameritrade, the strike is 130. I opened that on last November, expires next December. I have one contract. The price of the stock when I sold this option was 129, and I had said it was 125 before, but that was TROW's closing price that day. In the middle of the day when I sold the option, TROW was actually 129. Its current price is 107.47. So when I opened this option, there were 396 days. 172 have gone by, and 224 days to go. When I opened it, there was $1,928 premium to be realized. I've already realized $1,605 of that. But that number could go up or down depending on what TROW stock does. And I've got 323 more premium to realize. And this could also go up or down. I like to keep track of the next dividend and the next earnings here. This is the current amount of collateral I'm putting up. I need this number to compute the annualized yield. And you can ignore these two columns for not really important. This is what matters. These are just used to compute this. So when I opened this, I had the potential to make 16.5%, assuming it expired worthless. So over the first 172 days, I've made 31.7%. For the remaining 224 days, I could make 323, which is on that amount of collateral, works out to only 4.9%, which isn't terrible. It's like a nice yielding bond or savings account. So I'm not quite ready to roll down and in. But should this number get down to like 1 or 2%, at that point I would probably, depending on when it was, how much time was left, I may roll down and in, or I may roll up and out. It just kind of depends on how close I am to expiration. One other thing I wanted to mention is take a little deeper dive into why I did this in the first place. Why would I roll it so far up and out when the TROW had gone well beyond my strike? My previous strike was only 115, so it had already gone well above that to 129. I did the calculations, and if I could realize the appreciation up to 130, that was like 13% roughly, and then you add in 4 more dividends or another 4 or 5%, I was willing to wait for 13 months for that kind of return. The only downside risk was if TROW tanked, in which case I like TROW enough to where I would probably sell more puts on it and build out my position more. If you enjoyed this content, please like and subscribe. Thanks for watching until the end. Let me know in the comments if you have any questions or if you have an opinion on any of the TROW option transactions that I made.